Interesting, there's so much debate about whether these comments itself were actually dovish or hawkish. What's your take on what the Fed did?
Well, there's something for everyone, and I think you've covered it pretty well. There is a big gap until the next meeting, and inside that gap, you've got Jackson Hole, for example, which is when some of the big set piece moves can happen. Recent Jackson Holes haven't really given us too much of a surprise, for the market at least. That's one possibility. I really don't know, by the way. But every data release will matter. The Fed is not well served by the market front running them too much. And we have to think about that very carefully, because the forwards, which by definition move in advance, have already priced out the peak for yields. And that was around the last FOMC in the middle of June. So that's done. Others will be calling the inflation peak as well. There's the subjective probabilities around recession. All this is happening. Now, the thing is, if the market moves too fast and too quick to price it all in, then you get the loosening of financial conditions. And that's difficult to calibrate, of course, but it's going on in the background. So look, it's a long period of time until the next FOMC. I reckon that they're probably a lot closer to the peak than people think. I would take issue with the idea that they hike aggressively at every meeting through to the end of the year. To me, the markets are set for the Fed overshooting still. Don't forget, if neutrality is at 2 to 2.5, and the dot plot's got them going to 3 5/8, that's a fairly big overshoot. And to me, if it was so obvious that you have to go 100, 150 or so beyond neutral to come back to neutral, then just don't do it. Meet in the middle, and that's where the debate is right now.
Do you think then they'll be able to? I think the iteration of that right now, Stephen, is 100 basis points hike this year priced, and then it's 60 basis points of cuts next year. What is the market correct in pricing in lower rates next year?
Yeah, that's before I answer you directly, David. That's the difficult thing, to price in so much tightening followed by easing. The right. The elegant outcome would be presumably to do less, and any central banker who's candid enough to admit it would say that if it's so obvious we're going to make a policy mistake, let's not make the mistake. So the problem for the market is you need to be sure you're at the peak before you can really price in the easing. And that's why the curve isn't steepening aggressively. In fact, the coupon curve is inverted, as you can see. That's also why the dollar view might still be in flux. Right, so the forwards have moved first. Now we're waiting for the curve. For the curve to steepen, you need to be sure you're at the top, and we're not quite there yet. And then maybe the dollar call as well comes subsequently. I don't know. It's not my call to make, but in terms of the big macro calls that drive asset markets, those are probably the 2 or 3 that matter.
You mentioned that maybe we are getting to that peak rate scenario. Is there still value in the long end? I know you mentioned that maybe a month ago, or is that trade getting a bit too rich now?
Yeah, the 30-year is okay, around 3%. I think people will be happy to own long bonds at 3%. Don't forget, these are products that are complementing other assets. So you can buy credit closer to 5%. You can get high yield now with much more. So investors can now look to build a portfolio that's fairly robust and get close to 5% yield, say. So that's something that you couldn't do a year ago, which is new. As for the 10s, our forecast is 2.5 for year end, but it's been there since March of this year. We haven't chased it up and then down again. So to me, the near-term rally could start to get a bit stretched. And, I'd rather the market didn't get too far ahead of itself. Otherwise, we haven't got any juice left in the yield. So, yeah.
Right. Well, that takes us, as a final question, we'll continue the conversation in a bit, into them dropping forward guidance. Do you think that was a good idea?
Well, David, don't forget they've followed from others, notably the ECB did it in a more formal fashion. And here's the paradox. Well, to me, it's a bit of a paradox. It seems that bond volatility is often higher during the forward guidance and maybe becomes less when you take it off. That seems to be the wrong way around. But then that's the way markets seem to work, because whilst you've got the forward guidance on and you're giving indications about the forward points, any change is going to be really a big surprise. But once you've got over with it, once you've got that past that surprise and let the markets find neutrality and equilibrium, and the markets are doing that for the Fed, then we can respond to all the incoming data in real time. And that actually reduces the volatility. I mean, it's counterintuitive, but it seems to work.